Jamie Dimon has issued a bleak warning about the US economy and believes there are a number of reasons why we are heading towards a hard recession in 2023, which could spill over into a global economic crisis. Being the CEO of one of the largest banks and financial institutions in the world, Jamie Dimon's opinion certainly holds a lot of weight, and he has identified a number of key economic metrics that are getting worse by the month. Today I'll be diving deeper into Jamie Dimon's current thoughts on the economy, as well as the economic data around it. So Jamie Dimon appeared on CNBC in an interview early this week in which he made some very interesting points about the state of the economy right now. Dimon states that consumer spending is likely to weaken significantly due to persistent inflation as well as higher interest rates. Now this is forcing consumers to unwind excess savings that they've managed to put together during 2020 and 2021, a period where people were stuck in lockdown and there was less to spend money on in general. Consumer spending has risen by 10% over the past year and is now 40% higher than pre-pandemic levels, and high interest rates as well as continued high inflation are really starting to erode people's savings. Now Dimon believes that as savings deteriorate further and consumer spending falls, this may well derail the economy and contribute to a more severe recession. Now, according to the Bureau of Economic Analysis, the personal savings rate has dropped from a record high of more than 33% in April of 2020 to now being just 2.3% as of October's data. Now, the spike that we saw in early 2020 was obviously largely due to being in the middle of a pandemic, where the US government was handing out stimulus checks to many people, combined with the fact that there was not much people could actually spend their money on during that time period. But taking a look at where the savings rate was pre-pandemic in 2019, we can see that it was around 8 to 9%, which means that today's rate of 2.3% is drastically lower than compared to pre-pandemic. Even looking back at the historic average, the current savings rate is way lower than usual, and it's even worse than the lowest point seen during the 2008 global financial crisis, where the personal savings rate reached lows of 2.9%, which is still 0.6% higher than we are seeing today. Now, this is pretty concerning to see, that people are saving a considerably lower percentage of their income now compared to before the pandemic, and it doesn't even feel like we are remotely close to a peak recession just yet. And with higher consumer spending, we are also seeing higher household debt too, which is now surging at the fastest pace seen for over 15 years. And the most concerning thing about this is that it's mainly being driven by credit card debt. Credit card balances have increased collectively by more than 15% compared to this time last year, in the largest annual jump for over 20 years. Now, this brings total credit card debt up to $930 billion for Q3 of 2022, and according to a Fed official, this stems from a combination of robust consumer demand and higher prices. Sticking with non-household debt for now, we can also see that auto loans are edging up by 5.6% compared to last year, increasing from 1.44 trillion to 1.52 trillion. Student loans, on the other hand, are actually going down slightly year over year, decreasing from around $1.58 trillion to 1.57 trillion. If we now look at the housing debt, which is mostly mortgage balances, we can see that it has risen from just under $11 trillion last year to now being just under $12 trillion, representing a 9.1% rise year over year. Now, combining both household and non-household debt, we can see that total debt has jumped by $351 billion for Q3 of 2022, the largest nominal quarterly increase since 2007, and it brings the collective household debt in the US to a new record high of $16.5 trillion. Now, this increase in total debt follows a $310 billion jump seen in Q2, representing an annual increase of $1.27 trillion. All in all, despite credit card debt only making up about 5.63% of total household debt, it is still very concerning to see that it is still one of the main drivers of the surge in quarterly and year-over-year debt that we are seeing. A 15% year-over-year rise in credit card debt suggests that many people are turning to credit cards in order to continue funding their lifestyle. Now, maybe this is because they are genuinely struggling due to the cost of living crisis that we are seeing, or maybe it's because they are struggling to adapt to the new economic climate and are stuck in the past, trying to maintain their old lifestyle despite both prices and interest rates being a lot higher now compared to where they were a year or two ago. Ultimately, consumer buying power is decreasing because of depleting savings and rising household debt, now all of which is going to negatively impact corporate profit. Now, with consumers being in weaker financial positions on average, having less money to spend in the economy, any business that is selling goods or services to consumers is going to take a hit to their revenue and profit. Now, there are many negative knock-on effects from corporate underperformance that will have further impacts on the economy, and this can include unemployment rising as businesses are forced to cut costs by laying off staff as well as hiring less people. And unemployment is usually a lagging indicator of where the economy is at, so it may take 6 to 12 months to see this unemployment rise by a significant amount, as right now it is still very low. On top of this, with businesses suffering lower profits, we could also see further downwards pressure on the stock market. Now, low profits mean earnings underperformance and stocks dropping to fit back in line with previous price to earnings ratios. So Dimon also believes that interest rates will peak at 5% based on comments made so far from the chair of the Fed, Jerome Powell, as well as other central bank officials. Now, he also believes that the Fed will hold rates at this level for between 3 to 6 months. However, there is a possibility that this won't be sufficient, and this may lead to rates needing to stay elevated to this level for the best part of a year. Now, other risks to the US economy do include the central bank's quantitative tightening campaign, in which there is a fine balance between making sure they tighten enough and tightening too much. Now, we know that QT is not a positive thing for assets, and the last time that the Fed carried out any meaningful QT was in 2018, where we saw a drawdown of around 17% in the S&P 500. We've also heard Ray Dalio issue warnings about QT in the past, expressing concerns over a potential liquidity hole if tightening is too quick or too severe. So this definitely is something that the Fed will need to monitor closely to avoid causing any further damage to the economy. The current geopolitical environment continues to be a risk to all of us in more ways than one, and if tensions continue, then this could worsen oil, food and humanitarian crises across the world. Jamie Dimon does say, "We've not had a war in Europe like this since 1945, and back then we said never again." Add to that, by the way, a lot of emerging market countries that a lot of people don't focus on are going to pay a heavy price to the strong dollar, higher rates and higher oil prices. And so that stuff is really significant. I don't think we've seen that kind of turmoil in the global world for a long time. So Jamie Dimon is not the only prominent figure in the finance and investing world to give out such stark warnings on the US economy recently. And last week, Michael Burry issued a rather concerning warning on Twitter where he is predicting the upcoming recession to last many years with no way of ending it early. In this tweet he did say, "What strategy will pull us out of this real recession? What forces would pull us so? There are none. So we're really looking at an extended multi-year recession. Who is predicting this? There are none." So here he seems to be suggesting that there are no options available for the Federal Reserve and US government to avoid a prolonged recession. Now, Michael Burry has been critical of policymakers in the past, particularly with how much they have fueled inflation in his opinion, highlighting the excessive stimulus payments being sent out during the pandemic. Now, back in June, Burry was also quite vocal about many of the things that Jamie Dimon has been warning us of this week, including how Americans are facing surging prices and higher interest rates, which is leading to people saving less and borrowing more, along with predicting many Americans to exhaust their savings by Christmas. Now, these predictions have turned out to be scarily accurate when we take a look at the state of today's personal savings rate and average household debt. Also, another giant US bank in Morgan Stanley sent out a note to some of their clients on Monday warning about changing consumer habits. Now, this mentioned how the spending spree that has kept consumer demand growing quickly this year seems to be coming at the expense of savings and credit card balances, with credit balances now exceeding the pre-pandemic peak. Now, this note also states that unless the labour market remains strong next year, the strong consumer spending will likely subside, further weighing on the economy, which has already seen recession odds rising materially. Jamie Dimon also issued a damning statement on cryptocurrency where he likened crypto tokens to pet rocks, and he said that crypto is a complete sideshow, continuing his long history as a crypto skeptic. Now, in the same interview on CNBC, he did say, "Why do we allow this stuff to take place in relation to the recent collapse of FTX and the contagion that has spread across the crypto industry as a result of this?" Back in September, Dimon did tell lawmakers that cryptocurrencies are decentralized Ponzi schemes. However, in his annual letter to shareholders, he did write, "Decentralized finance and blockchains are real, new technologies." Now, it's clear that Dimon is quite critical of the cryptocurrency industry overall, despite appreciating some of the technology that is used in it, such as blockchains and smart contracts. Overall, though, it's fairly safe to assume that he's probably quite bearish on the whole crypto sector in the future, despite him not explicitly saying this. Now, if you think the economic situation is bad in the US, then wait until you see some of the things that are going on right now in China. If you want to learn more about this, then check out my video on the screen right now, which goes into full detail about some of the recent developments in China that could affect their economy in the long term. I think you'll certainly enjoy it. Aside from that, be sure to leave a like if you enjoyed the video, subscribe if you want to see more videos in the future, and thanks a lot for watching.